Good afternoon. This is Jim Perry at Perry Capital on Saturday, July 18th. It's heart of the summer and World Cup finals weekend. England and France square off in Miami tonight. Spain and Argentina in the final in New York on Sunday. The Tour de France is going on, as well as the Open Golf Championship in England. So very busy weekend in sports and a very high intensity period for investors and markets. The market narrative is negative, as it tends to be, but there are a lot of very good things going on in the economy with American businesses and American consumers. We'll talk about that in a minute, but the topic of today's discussion really is about the key issues that are making investors nervous. First among them is the Moonshot moment, which is surrounding the AI industrial revolution. We're going to talk about that and others right now. Investors are worried most of the time about many things. On the top of the list is return on investment at the CapEx level by the hyperscalers. We know what the supply side of the argument is. We know what they've spent. It's about $1 trillion over the last 3.5 years or so. Most of that this year. Return on investment is a little trickier. There's a company called Endeavor AI out of London who did a really good report. I got it 2 weeks ago. It's about 50 or 60 charts. They've done a good job trying to calculate the return on investment. They will be wrong on some of their measurements, and it is slightly subjective, but based on what they are doing, they see that revenues in the AI space have totaled $175 billion so far this year. Furthermore, that the run rate will probably be over $300 billion. That's a pretty good number, and it will make me feel comfortable knowing that the CapEx spending will continue. How you finance that is another risk. We'll talk about that in a second. But the point is, I wanted to put this chart up there. This is the core of the whole issue. Thank you, Goldman Sachs, for the chart. This is a proxy for the cost of computing and data processing of large language models at the AI level. It started in December of 25. It has risen 100% to June 1st, and since then has come down about 25%. I think that's a good thing. Devon's paradox is well documented. As the price of a technology goes down, more people use it. I think that will be the case here. The Moonshot moment this week was the announcement by the Communist Party in China of a new model called Kimi 3. It is untested, although they say it rivals Anthropic and OpenAI. They said the same thing about DeepSeek. DeepSeek is down at the lower level of compute. A lot of people are using it. That's great. The more compute, the better, as long as this OpenAI Chinese model stays out of the networks in this country, which I think will be the case. It's the case with DeepSeek as well. I think there's a lot of risks in the AI space. The Moonshot moment, I don't believe, is one of them. There are others. We'll talk about that right now. Gauging risk with respect to escalation of the conflict and hostilities in the Middle East is price of oil. Oil was at $65 a barrel on March 1st, first day of Ramadan, when the conflict started. Stock market bottomed on April 1st, when Artemis 2 took off from Cape Canaveral to the moon, and no surprise to see oil going down into Independence Day weekend, which was July 2nd was the low at $65 a barrel. We did a full round trip. Since then, oil's up 25%. No surprise to see major portions of the stock market down an equal amount. The inverse correlation is extremely high. When oil prices go up at this moment, at this time, in this cycle, stock prices are going down. Why? Because they're expensive anyway. And oil is cheap. It's going to go up if the conflict continues to escalate. And I think it will. We do not have a free flow of oil through the Strait of Hormuz. Until we do, the price of oil is not going to come down and the global economy is at risk of a slowdown. So, watch the price of oil. If it looks like it's going to keep going up, I would be a little bit less than enthusiastic about the stock market. Volatility is another gauge of risk which investors have to consider every day, and they do so. The best measurements for risk, and there are many of them at the broad portfolio level, is the VIX, which is the volatility implied of the S&P 500. Closed at 18 this week. It was as low as 15 a month ago or so. Yet at the same time, volatility at the individual stock level is up 50%. And we see big moves in stocks 5 and 10 and 15 and 20% every single week. Expect that to continue as the market filters out the winners and losers in an economy that is changing very, very quickly, in a technology sector that is changing quicker than that. Expect it to change and continue to change rapidly. Pick your sectors, pick your best in class and your worst in class. Do what you need to do. Perry Capital does that as a discipline for 30 years. That's all we do. We try to beat the S&P 500 with less risk every single month, every single quarter. We have for 30 years, and we're going to continue to be disciplined with our risk and disciplined with our approach in risk taking. You should too. There's a truism when it comes to risk in the global markets, and that is that the FX investors get it first, the bond market gets it second, equity investors get it third. I believe that to be true. Dollar is rising, money is coming into this country, the dollar is stable and rising. That is clear, not a risk. Number two, the bond market messages are also very clear. Investment grade spreads are at 77. March 1st, they were at 95. And when Russia invaded Ukraine, they were at 170. High yield spreads, they're now at 266 or 267, 268. In March, they rose to 335, and when Russia invaded Ukraine, they were at 600. Corporate credit spreads are telling you the risk of recession are low. Credit spreads in the hyperscaler space are up a bit in the last month or two. I wouldn't think of that as something that should be alarming at the moment. I think that they will continue to spend more and spreads will tighten as revenues begin to trickle in. So I think the message in the bond market is no recession, no inflation. As far as inflation is concerned, if you look at inflation swaps, in a year they're at 230. The CPI number came out this week. It was the lowest it's been in months and the largest negative reading in several years. So expect inflation to come down. Don't expect interest rates to go up much further than here. And I certainly don't think that rates at this level are any impediment to the continuation of corporate profitability. Liquidity in the financial system is ample and it's actually rising. Global GDP is about 100 trillion. Global stock markets are worth about 100 trillion. Global money supply, if you add it all up, is about 300 trillion. It's never been higher. Half of the increase since the pandemic level has come from China. They're printing money like crazy because they don't want their GDP to show a negative number. China is in trouble. I wouldn't invest in China, quite honestly. I wouldn't invest in Asia. But the point is that the bond market message is one of stability and should not be a risk factor that keeps investors up at night. If you have a bond portfolio, that's a different story. Bond investors think about the world in a different way. They don't care about how good things are going to get. They just care about getting their money back. And they will always worry about getting their money back. So bond investors get it second. And bond investors are telling you that the risk is low.